Hello, students. My name, as you all know, remains Johnson Oko, an Associate Professor of Finance. This week, our topic is on bank customers and account types. I promise you it's going to be an interesting ride. Thank you. Intended learning outcomes for today's class will be extracted now. So at the end of this class, students should be able to state who a bank customer is. 1. 2. Students should be able to state the various types of bank accounts that operate or that are operational in the bank. What are these accounts? 3. That students should be able to discuss the nature of banker-customer relationship. There are different relationships that exist between a banker and a customer depending on the circumstances. By way of introduction, banking business has always been a contractual and fiduciary relationship between the bank and its customer. Therefore, such contracts, such fiduciary relationship must be well understood and must be well taken care of in this class. To leave funds in the hands of a legal entity is no joke, because customers have to trust that legal entity. They have to believe, have to have the hope, have the assurance of the safety of their funds, and be sure that the trust issue is not there. However, being a banker or a bank customer entails a lot, among which is the fact that one must have an account with the bank before anything else. So, a customer, for a customer to be adjudged a real customer of the bank, such person must have an account relationship with the bank, and that establishes that link or that contractual and fiduciary relationship. Therefore, there exists a complex web of this relationship that requires proper elucidation, and justice will be done to it. Who is a bank customer? In the banking business, just like any other business, the customer is the king. The customer is the whole fulcrum of the existence of the bank. No customer, therefore, no bank. Therefore, the issue of who a customer is very crucial and important that we should know. And therefore, we should also understand what type of relationship that exists between these two parties, the banker and the customer. Ordinarily, the term customer refers to any person who enters into a contract for goods and service interaction with one another, whether shop or business entity. Yes, in the ordinary parlance, once you buy or sell goods to one another, then there is a relationship, a customer relationship. However, the situation in the banking sector is different, because the mere giving of financial advice can constitute a banker-customer relationship. There may not have been an exchange of goods for money or money for other products. What then is important is the determination of the nature of the relationship. There must be some sort of account, either a deposit or a current or similar related account, to make a person a customer of a bank. Again, whether the account is opened by the person himself or by another person on his behalf or upon his authority is irrelevant to constitute him or her as a customer. But what is important is that account relationship must be established upon opening of accounts. Nature of banker-customer relationship. The relationship that exists between a banker and a bank customer is basically contractual in nature and are varied. First, we have the debtor-creditor relationship. Yes, the debtor-creditor relationship. At what point is the banker a debtor, and at what point is the customer a debtor? At what point is the bank a creditor, and at what point is the bank a creditor? When a customer has a credit balance in a bank, the bank in this scenario becomes the debtor, while the customer is the creditor. But if the reverse is the case, and that the customer is enjoying a credit facility, then the bank becomes the creditor and the customer becomes the debtor. There's another relationship, which is the agent-principal relationship. The agent-principal relationship is another prominent relationship between the banker and the customer. The bank or the banker serves as an agent to the customer when the customer deposits a check for clearing. In this instance, therefore, the customer is the principal, while the bank remains the agent. So that's the agency relationship. We also have the bailor and bailee relationship. Bailor-bailee relationship exists in a payment arrangement. When a customer comes to deposit things of value and of trust with the bank, the customer is the bailor, while the banker or the bank is the bailee. In this instance, there is a payment arrangement. That arrangement will presuppose the role of the bailor and the role of the bailee. And this is not done for free. It is done at a charge on the bailor. And the bailee receives this as an income. The bailee in this instance is the banker. We also have the pledger and the pledgee relationship. The pledger, especially when a customer borrows from the banker and he pledges a security, whatever security that the customer pledges with the bank serves as a collateral. So when the customer pledges before the banker, the customer is the pledger, and the bank in this instance becomes the pledgee. We also have the trustee and the beneficiary. Trustee and beneficiary relationship. The bank can serve as a trustee to its customers. In this instance, the third party can benefit from the arrangement. We also have the advisor and the client relationship. The advisor and client relationship, the banker can serve as the advisor, while the customer serves as the client. So at one point or the other, customers can come for professional advice from the banks, and such advice or advices are given to the clients to enhance their business and to also affect their professional decisions. We also have the hypothecator and the hypothecatee. Hypothecatee is an arrangement between the banker and his customer, where the customer has to drop some stocks. It can be movable assets or assets that are stationary. Banks can now take them, hypothecate, take a lien on them, and when once these products are being hypothecated, there's an arrangement such that at that point, the stocks or the asset whatsoever is used as a pledge for a facility, a credit facility that is availed to a customer. So in this instance, the customer becomes the hypothecator, while the bank serves as the hypothecatee. Account opening in banks. Any person, natural or legal, whether artificial person or an individual with life, has the right to open an account or a loan account with any bank, even a minor. In this instance, it will be operated by an adult until the minor comes of age. The essential thing to do on the part of the bank is to seek formal and proper identification of a prospective customer and obtain proper introduction or reference as regards the customer. The banker has a duty of care and a responsibility to ensure that whoever walks in to open an account, or whoever that is marketed to open an account, is duly identified. And in this instance, there are acceptable means of identifications. Those acceptable means of identification include the national identity card, the driver's license, the international passport, and the permanent voter's card. Therefore, a prospective customer should be able to make this available. Sometimes the bank go a step further to ensure that the customer provides utility bill to enable the customer verify the address of such customer, because the banker has a duty of care and responsibility to do due diligence by way of know your customer and know your customer's business. The standard expected of a reasonable banker is to make initial inquiry about the prospective customer's identity or character before opening any account. It is very, very important. Account opening for companies. In the case of a limited liability company, much broader steps are being taken, and these steps include, but not limited to this. One is that you get references of the directors of the company and request for the production of the original certificate of incorporation and obtain a copy therefrom. So, for any limited liability to operate an account, the banker is expected to get the references of the directors. And these references are usually given by third party who operate current accounts in banks and can say that the directors have the character and the capability to run accounts on behalf of the companies. So the original certificate of incorporation is also necessary because it enables the banker to know that that company is actually incorporated, is established by law to run its business, and therefore is an official and a legal being that can be sued and can sue. Again, is that the banker should obtain certified true copy of the memorandum and articles of association. Every limited liability company must have a memorandum and articles of association. Such memorandum and associations will speak volume as to what the business is all about, as to the address, the official address of the business, and as to the do's and don'ts of that company, and as to the relationship of that company with the externals and its internal policies. The articles speaks more on the internal arrangement and internal mechanism of the organization, while the memorandum talks about the company and its relationship with the outside world. Thirdly, the banker should obtain specimen signatures of all who are to operate the accounts. So it is necessary for the banker to obtain the specimen signatures, and these specimen signatures will be deposited in the bank, which will now serve as a mandate. Then upon which the mandate for the account is chosen, whether all the signatories will be signing, or whether some of the signatories will be signing, or what is the tune of the amount each signatory can sign or can withdraw. Then fourthly, request for a copy of the certificate of commencement of business. So that certificate of commencement of business is very important to show that the company did not just register or is not just incorporated, but that the company is authorized to commence business or has commenced business. Yes, so far so good. We have gone through some very crucial topical areas, and I think now we should look at what to test whether the level of our knowledge, whether all that the teacher, your facilitator, have been saying are being assimilated. Therefore, we'll have a class activity right now. Remember that we've talked about the different types of relationship that exist between a banker and a customer, and we have also attempted to give examples or instances. So the class activity now is for students to be able to identify or state 5 types of relationship that exist between a banker and a customer. And the second activity is for students to attempt to discuss the relationship with examples. So that's the activity for today. So we should be able to attempt this, and once you attempt it, you'll be recognized. Thank you. So, believing that the class activity is robust and interactive, we move on to the next slide. By this, current account is usually a checking, addressed as a checking account, an account that you can use check to withdraw your deposit or funds from. Not necessarily from the branch where that account is opened, because today, with the advent of internet banking, with the advent of electronic banking, with the advent of digital banking, and with the advent of online systems, online real-time, all branches of banks are connected, and customers of banks now enjoy the latitude, the freedom to withdraw the account from any branch of the bank. So, but what is important is that the customer has to have a check account, has to have a check, and a check slip is usually given to the customer, and the customer can either write that check in his favor or write in the favor of a third party, who will so present the check either at the branch the account is open or any other branch across the country. So the special thing about current accounts, again, is that no interest is usually payable on account balance. Rather, there are charges, and these charges are a form of COT, commission on turnover. Although sometimes the bank may decide at a threshold, may decide to pay some level of interest. The account holder may be a creditor. Another special thing, when there is a cash balance to the bank at one point, and at another point, the same time, when there is a circumstance that the account is overdrawn, then that customer becomes a debtor. If the account is overdrawn or the customer is enjoying an overdraft facility. If the customer becomes a debtor, the bank then becomes the creditor. So it's important for us to identify and understand this scenario. Deposits or savings accounts. Once you hear deposit accounts, it's also known as savings accounts. Although there are different types of deposit accounts, you can have a time deposit, otherwise known as fixed deposit, or you have the ordinary savings account. Nowadays, there are different hybrids of savings accounts. But one key thing is that the clearing checks are not given on this savings account. If at all there is any check that's given, such checks do not go for clearing. So this is fundamentally a savings account in which the account owner makes periodic savings with the intention to make interest. In recent times, the savings account has become more flexible, adding checks and other methods of withdrawal, ATMs, POS, internet transfer of funds, or electronic banking. So today, there are different variants of savings accounts in different banks. Hybrid savings account that allows the use of check. But what is important is that such checks would hardly go for clearing. So they are usually domesticated to the bank. Therefore, we are going to look at the basic differences between a deposit and a current account. There are different, we have attempted to mention them. However, I would elucidate by taking them in bullet form. A deposit account is a lodgement or savings account, while a current account is a payment or withdrawal account. Usually when you run a current account, it's for withdrawals. It is not intended for savings. But once it's called savings, it is intended to save, and the frequency of withdrawal is reduced. However, there is now a thin line in terms of withdrawal rate between a current account and a savings account, as most people nowadays operate their savings accounts and withdraw as frequent as they like. It was only in the time past that there's a restriction on withdrawal for savings account. So a current account holder utilizes a checkbook in withdrawals, while a deposit holder usually uses savings withdrawal slip, though in recent times it can operate a check system with limited capacity. I've said this before, that a current account utilizes a checkbook, while a savings account utilizes a savings withdrawal slip. But in recent times, some savings hybrids of savings accounts now have a check leaf. But there's a caveat that most of those check leaves or check systems are limited in capacity, in the sense that they will not be presented for clearing. Statement of account holder is given periodically, either in hard copy or electronically, and sometimes upon request. But for deposit transactions, details are usually on passbook. Yes, this is also another old point. Time and season has changed it. Current account, although they are still entitled, savings account holders are also entitled nowadays to have statement of accounts. And besides that, the issue of passbook had been phased out, and people hardly have passbooks because of the online real-time system. But rather, once they want to withdraw, they are giving withdrawal slips. And if they want to deposit, they are giving deposit slips. That's another point. Thirdly, is that current account holder. There's commission on turnover. I mentioned it, which is usually charged, but not for a savings account. Commission on turnover is not to be charged on a current account. It's not to be charged on a savings account, but rather commission on turnover, otherwise known as COT, is charged on current account holder. And the rate varies. Before this time, much more before this time, it used to be 5 per mil, but recently it is now 1 per mil. That's 1 naira in every 1,000 naira. Lastly, the deposit account balance attracts interest, while the current account holder is not paid interest. We have tried to explain this. The deposit account holder, that is the savings account holder, is entitled to interest, but the current account holder would rather pay charges instead of receiving interest. So, but banks now, once you withdraw more than 3 times in a month, you forfeit your interest on savings accounts because it's perceived as though it is run like a current account. More than one person upon which there is a collective ownership or a joint ownership or a joint claim on that account. Wife and husband can open a joint account. Partnership can open joint accounts. Trust accounts can open joint accounts. Executorship and trusteeship accounts do exist, and usually joint accounts may be for the beneficiaries of the estate. Administrators of legal practitioners, limited liability companies run joint accounts, and these accounts are run with mandates from the account holders, and there's the joint responsibility and also joint claim by its owners. Partnership account. Partnership account, this is the type of account that their agreement simplifies the rights or power of partners with relations to the partnership account. Section 5 and 6 of the English Partnership Act of 1890, as applicable to Nigeria, a partner in an organization or a company is an agent of that organization, which his or her function is for the business of an organization. The fact here is that partnership entitles each partner to open an account in his or her name for the organization and to hold up the partnership account. Meanwhile, the banker can as well prove that the partner was acting as an agent of the organization, that's the company, that the account belongs to the organization. Dissolution of a partnership, the power of a partner to draw from the account of the organization stops. So at dissolution, at the winding up of the partnership business, the power of a partner to draw from the account of the organization ceases. Very important. Limited liability account. Something very important will be considered when opening corporate accounts in banks. Firstly, limited liability company has a separate legal personality different from those of its shareholders. Yes, it is clear that companies are artificial persons, distinct from its owners, that can sue and that can also be sued. So there is duty of care and responsibility on the part of the banker when accounts are being opened for limited liability customers. Thirdly, for incorporated account, the bank considers the implication of the doctrine of ultra vires, which affects not only the capacity of the company to borrow money, but on how the money will be protected. So, because banks are concerned about the artificial personality nature of companies, they look at the capacity of the company to borrow, and not just the capacity of the company to borrow, but on how the money will be protected. So banks will put institutional policies and principles in place to ensure that funds borrowed by companies are utilized for the purpose for which they are borrowed for. Again, is that the articles and memorandum of association, being public documents, are open to all persons and banks who may have any transaction with constructive notice of their content. The articles and memorandum of association are public documents and are open to any person or any banker who would need such documents for constructive evaluation of their relationship with the limited liability. Conclusion, therefore, bank-customer relation being a contractual one interchanges position. There is usually different positions between a bank customer and a bank. This is because a creditor today may be a debtor tomorrow. Hence, you need to know how it works and the type of accounts in operation. Bank customer relationship is a complex thing, and the account interpretation hovers basically around the deposit and the current accounts. A bank planning to lend money to an organization, company, must inspect the memorandum and articles of association before making any payment or taking anything as collateral for borrowing. The banker should, as a matter of importance and necessity, review the object clause and other clauses in the memorandum and articles of association to ensure that they can engage such company in borrowing or in lending activities or in any other activities. Though a company may be authorized to borrow, articles of association contains directives of how money is to be applied. Although a company may be authorized to borrow, yet you need to look at the articles of association to see how such money borrowed should be applied. Very important, and we have discussed it, that it is very important for the banker to review and evaluate and appraise the amendments and the memorandum and articles of association before releasing funds to the company or its directors. This implies that if the directors borrow money out of the scope of the companies, this will be ultra vires, and the bank may have difficulties in recovering the money from the firm. It is very, very difficult for banks to recover money that is borrowed ultra vires. Thank you.